Jason, you talked about what's going to happen, in America with the quantitative easing, and it's something a lot of people have actually been asking. So perhaps you're going to be able to give our viewers some of this answer too. When it comes to an end in America, and it will, and it has to at some point, what's the fallout going to be?
Well, I think there are a couple things right now. I think, first of all, when we think about what's the role of quantitative easing for the U.S. economy or for the global economy right now, it's really one of the key things that's instilling and engendering demand in the U.S. and helping keep the global growth at a pretty solid level. What we find is that without that QE infinity, we wouldn't be in nearly as good a spot. When it does end, the question is, how bad an impact will that have? Will the U.S. economy be stable enough on its own to maintain the growth rates, or will we see a little bit of a pullback?
Well, absolutely. I mean, surely that's the idea, that they won't stop it until they're actually seeing growth, because we've listened to some of the minutes of the Fed meetings, and I know you attended some dinners with Mr. Bernanke himself, where he's been there, so you've heard it directly from him. The concern where, yes, it might look, some people are saying it's got to end, but whereby he's saying, we're not out of the woods yet.
Well, no, we're not out of the woods yet, and I think this is also something OPEC is very much thinking about, very cognizant of, the fact that the global economy is still on somewhat shaky footing. Europe is contracting. We have China that's slow, and the U.S. is really holding it all together. There is an economic theory about pent-up demand, and that's what Ben Bernanke and the Fed and other central banks like the Bank of England and the Bank of Japan that are engaging in their own quantitative easing, this is what they're all betting on, that eventually you keep rates low enough, long enough, you make money cheap enough, people spend, you get more growth, and everything's fine, and you have a perfect landing. But that's where the trick comes in. But that's what everyone, including OPEC, the central bank of oil, is betting on, that all of this accommodative monetary policy in place everywhere globally leads to stronger growth at the end of this year and next year.
Tell me a little bit about your new theory on the central bank of oil. I like that one.
Well, the truth is, when we think about what central banks do, is they're trying to regulate supply, usually of currency, in order to influence interest rates, which then indirectly influences growth. For OPEC, as a central bank of oil, they try to influence how much supply is going to the market in order to help reach a target for their volumes and pricing. And so, in a certain way, they're also planning around what do they think happens to the global economy. They're always responsive. Central banks are also responsive. What do they think is going to happen next? But really, that's the thing. Demand is really, really critical here. In a good year, what OPEC's producing now would be nowhere near enough. In a weak year, it could be a little much. And in the back half of this year, right now, people are expecting things to get better, which is one of the reasons we don't expect a production change to be announced today.
Now, when we look at the price, particularly on Brent crude, I mean, that price has held pretty steady right throughout the year, staying above $100 a barrel. We saw a dip down in April, but again, it rebounded. That's pretty good in terms of being able to maintain that stability in the market.
Yeah, I mean, when I talk to my clients about what OPEC's looking for, they don't have an explicit price target, but many ministers have said the $100 to $110 range. This is a range that the members are comfortable with. They feel is fair, it's sustainable for growth. So although they don't have an explicit target, if you were to say the $100 to $110 range, I'd say, yeah, that's probably what they'd like to see based on what we've heard anecdotally and from the different ministers, what they've said about pricing being fair and sustainable. The price dipped only very briefly below 100, as you pointed out, but I think we're likely to see this price range of the 100 to 110 range continue throughout the year. But again, if there's more growth at the end of the year, there's going to be upside, and if there's less growth than everyone is expecting, the IMF, the OECD, OPEC, Prestige Economics, what we're all forecasting, if we see less growth at the end of the year, we're going to have a very different OPEC meeting in December.
And what is the reality of the prospects of less growth?
Well, I think we're going to have another year of getting rich slowly, where the global economy is expanding in the 3 to 3.5% range. The U.S. economy is expanding around 2%. It's not a great year. It's an okay year. But an okay year for the global economy still means more oil demand growth, because emerging market demand for oil on the per capita basis is so low. There's so much headroom that when we look out further and we think about things like shale oil, we're going to need that oil because of upside. What happens if we have a good year? What happens if next year is good for China? Well, then we're going to need a lot more oil.
Talk to me about shale oil. I mean, people talk about it as a revolution, but again, the ground is being depleted at a much quicker rate. I mean, how does that impact? And so in the short term and maybe the medium term, there's a lot of oil around, but when we look longer, how does it look?
Well, I think there's a couple things here. I think one is America's the exception, not the rule. There are other places where the shale oil could be drilled, but there are different political reasons, economic reasons, lack of infrastructure, meaning cost reasons, that are going to keep that from happening. Even in the U.S., to develop more oil and gas shale over the next 25 years, it's expected to cost around $200 billion in additional infrastructure. So we need to spend a lot more money to get that oil and gas out. Now, is there more supply? Absolutely. But there are decline curves that are quite steep. So unlike a conventional oil well that you drill, which may be easier, difficult to get to, you drill a vertical well and you pull out the oil at a fairly consistent rate over a period of time with a slower decline curve. With the horizontal drilling, with fracking and with the shale opportunities, you go in, you frack the well, you pull the oil out, it comes out in a big burst and then drops off very sharply. And this means you need to continually drill and frack and drill and frack and drill and frack. And so the question is, are you going to continue to find wells that are as easy to drill and frack? Are you going to continue to get as much oil over time? Are you going to have to go to those next marginal level of wells? You need to keep drilling and drilling and drilling. So it's not a process that's ever going to slow down.
And when we look at what's going on in America too, it's an American solution, I guess, to their energy demands, but it's certainly not a global solution, is it?
Well, it's not a global solution, but if we have more oil in the U.S., that frees up other supplies from elsewhere in the world, including from some OPEC members like Nigeria. That oil would have gone to the U.S., but now it doesn't need to because the U.S. has more oil, so that oil can go elsewhere, to Asia, to other emerging markets where you see that growth. And I know OPEC's done a number of reports on where the emerging market growth is coming from. I think 87% of the demand growth over the next 25 years is coming out of Asia and China.
Now we're almost at the half point of the year, really. We've 5 months in, and again, a good time to be taking stock. When we're talking about stock, inventory levels in America are pretty high, actually, at the moment. The fundamentals seem pretty favorable. They shouldn't have been too much of a concern, really, apart from the bigger picture at this meeting. And we've seen that consistency in the market and, again, supply and demand, the fundamentals are strong. When we look down to the second half of the year, what are the things they need to be concerned about?
It's about Europe, it's about China. Everyone, the central bank of oil, like the European Central Bank, like the Bank of Japan, like the Fed in the United States or the Bank of England, they're all counting on more growth in the second half of 2013 and better growth in 2014. Even just this week, the OECD lowered their growth revisions. IMF lowered them last month. But if we look at next year, growth expectations of 4% are pretty common. That would be significantly better than this year's 3 to 3.1, 3.3% growth that the OECD and IMF are expecting, respectively. So everyone's expecting more growth at the end of this year and next year. What OPEC needs to be worried about is it going to happen? And that's where the really big question is. That has to be their number one concern. Shale and these other things, that oil will find a home as long as global growth is okay. And that's really what their number one concern has to be right now.
And I mean, in the event that we do see a bit of a buoyant year coming to the back half of this year and indeed above, where can we get more oil resources? Obviously, we know Saudi Arabia can turn on the taps and can deliver more oil to the market. But there are some issues, too, around the security issues in many of the countries. We're looking at Libya, Iraq even, and, Nigeria's had its own problems. So tough times individually for these countries, and they need to be keeping that on top of their agenda.
Well, I think every country has its own specific set of issues, but I think in general, I'm much less worried about global supply and global capacity. We've seen Saudi Arabia, for example, be very responsive to slower growth dynamics in terms of their own production. They could easily turn it back up a little bit, and I think if we were to see higher prices, you would potentially see additional fracking and shale drilling in the U.S., and I think you might see an even more rapid increase in production in Libya and Iraq. And while there's always geopolitical risk, in most of the member states right now, things seem pretty quiet.